It's great to have you, Aswath. I mean, coming into this period after this very strong run we've had over, say, 3 or 4 months, did the market as a whole have a valuation problem, or did it really, change the risk reward looking forward?
I think the market has been bimodal. The first part of the year, I think the market built in expectations that things would get a lot worse. Then in the last 3 months, it almost seemed to switch and go in the other direction. The truth, I think, lies somewhere in the middle. And I think we're going to find out over the next 2 or 3 months where that steady state is. But I do think markets got a little overstretched over the last 3 months, expecting the best of things.
All right. And were there parts of the market that you felt as if just got either, overdone or were left behind? But, many of us keep talking about how it's in some respects an unbalanced market, just in terms of the massing of market cap in one area and in the kind of secular growth parts of this market. And yet those secular growth parts of the market is where all of the upward earnings expectations have been as well.
I mean, if you look through April 8th, the Mag 7 stocks lost almost, 20% of their market cap, trillions of dollars in market cap. What's happened in the last 3 months is not only have they recovered that loss, but they've added another couple of trillion. The key word is trillion. I mean, we're adding magnitudes of value to these stocks that I don't think they can sustain given the economy, given the company's own capacity to generate earnings and cash flows. So that's what I mean by overstretched. I think that, these are great companies, but they're not as great as the market thinks they are in terms of what they're bidding up the market cap to.
You mentioned that by most lights, I suppose, the economy had been holding up better than many would have expected, given the tariff overhang and even the tariffs that already have been imposed. Does that still seem to be the case in light of today's jobs numbers and some of the consumer spending data we got this week?
I think here again, the market was never as bad as the economy was not as bad as people thought it was going to be on April 8th. And it was never going to be as good as people thought it was even last week or earlier this week. So I think we're going to get more reports like this where we go back and forth between the optimists who say, hey, this is going to be okay, and the pessimists who think that this is just front-running what's coming with tariffs, and you're going to see a much slower economy in the rest of the year. And you're going to see these reports come back and forth, and the market is going to be whipsawed every time a report comes out in terms of whether it's good news or bad news.
I'm fascinated by, you mentioned that just the trillions of dollars in market cap that have been kind of added to and occasionally subtracted from that small group of stocks. When it comes to NVIDIA in particular, which did peak at around a $4.4 trillion valuation before this little pullback, I mean, the volume of dollars added to the top and bottom line by this company is I think, unprecedented in a short period of time. It's going to be $250 billion in revenue next year, it appears, and about half of that falling to the bottom line. Is this the kind of thing? I mean, how do you treat that in terms of, do we extrapolate that as the run rate? Do you give it a premium for that, or do you assume that it's going to have to just revert to the mean?
Oh, we're not just giving a premium. We're giving a super premium to it right now. I think nobody is contesting the fact that NVIDIA is an amazing company. Jensen Huang is a great CEO. I think the question is, how great is he and how amazing is it? Because what the market is doing is building into the market cap, I think, expectations that are going to be really, really, really difficult for even NVIDIA to meet.